Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about LAMB WESTON HOLDINGS INC. Quarterly Report. LAMB WESTON HOLDINGS INC. offers a diverse range of products and services to various industries. The company's primary business involves the production, distribution, and marketing of frozen potato products. These include frozen potatoes, commercial ingredients, and appetizers under its own brand, as well as under customer labels. The company provides its products through multiple channels, including internal sales personnel, independent brokers, agents, and distributors. Its customers span across various sectors, such as quick service and full-service restaurants, wholesale, grocery, mass merchants, club retailers, specialty retailers, food service distributors, institutions, and convenience stores. Some of the notable brands under which LAMB WESTON HOLDINGS INC. offers its products include LAMB WESTON, grown in Idaho, Alexia, and other licensed brands. The company's extensive network enables it to cater to a wide range of customers, from small independent restaurants to large chain establishments. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified by examining the key factors that have contributed to these outcomes. On the positive side, revenue growth has been driven by several factors. In the North American segment, net sales increased by $37 million due to share gains and strong customer retention. Additionally, sustained growth in QSR chicken sales and execution across sales, operations, and supply chain have also contributed to revenue growth. Furthermore, a volume increase of 8% was achieved through customer wins, share gains, and retention in the North American segment. Favorable foreign currency impact has also played a role in driving revenue growth in this region. On the other hand, revenue decline has been driven by several factors. In the international segment, unfavorable price/mix and higher manufacturing costs per pound have led to lower adjusted gross profit. The net write-off of excess raw potatoes within the international segment has also contributed to revenue decline. Higher fixed cost absorption associated with lower utilization of international production facilities has further exacerbated this issue. Overall, these factors highlight the importance of effective pricing strategies, supply chain management, and customer retention in driving revenue growth or mitigating decline. The net income of the company experienced a significant decline between 2025 and 2026. The year-over-year decrease was 63%, from $146 million to $54 million, while the quarterly comparison showed a 24% drop, from $237.3 million to $180.4 million. The profit margins also underwent changes during this period. The gross profit margin decreased by 6.6 percentage points, from 27.8% to 21.2%, and the operating income margin dropped by 9.4 percentage points, from 16.5% to 7.1%. However, there was an increase in the North America segment's adjusted EBITDA margin by 14.7 percentage points, from 12% to 26.7%. On the other hand, the international segment's adjusted EBITDA margin decreased by 5.8 percentage points, from 12% to 6.2%. The total company profit margins also declined, decreasing by 1.2 percentage points, from 4.9% to 3.7%. The reasons behind these changes are attributed to various factors, including an increase in depreciation and amortization of intangibles and debt issuance costs, a decrease in blue-chip swap transaction gains, and an increase in cost, savings program, and restructuring expenses. These factors collectively contributed to the decline in net income and profit margins during 2026 compared to 2025. The company's financial performance indicates a positive trend in its operating cash flow. The data shows that the net cash provided by operating activities has increased from $485.3 million in 2025 to $595.6 million in 2026, resulting in an increase of $110.3 million. This significant growth suggests that the company is generating sufficient cash from its core operations to meet its financial obligations and invest in future growth initiatives. Furthermore, when comparing the operating cash flow for 2026, $123.40, with the previous year's figure, $141.90, it appears that there has been a slight decrease. However, this reduction does not detract from the overall positive picture presented by the increase in net cash provided by operating activities. The company's ability to generate positive operating cash flow is a crucial indicator of its financial health and stability. In conclusion, based on the data provided, it is clear that the company is generating positive operating cash flow, with an increase in net cash provided by operating activities from 2025 to 2026. This trend suggests that the company's core operations are profitable and capable of producing sufficient cash to support its financial obligations and future growth initiatives. The company's debt level has undergone significant changes between 2025 and 2026. While the current portion of long-term debt and financing obligations increased by $2.8 million, short-term borrowings decreased by $101.6 million. Long-term debt and financing obligations, excluding the current portion, also saw a decrease of $39.9 million. However, the total debt and financing obligations increased by $141.5 million, indicating an overall rise in debt levels. Furthermore, net interest expenses rose from $279.8 million to $291.8 million, suggesting that the company is paying more in interest payments. Despite this interest expense, net declined by $2.8 million to $133 million, which may indicate some cost savings in interest payments. The recent financial results show a mixed performance across different segments of the company. On the positive side, the North America segment stood out with impressive growth in net sales and volume. The segment's net sales increased by 5% to $1,035 million, while its volume grew by a significant 12%. Furthermore, the adjusted EBITDA for this segment declined only 4%, indicating a relatively stable profitability. In contrast, the international segment struggled with declining net sales and adjusted EBITDA. The segment's net sales decreased by 1% to $529.8 million, while its net sales at constant currency declined by a more substantial 9%. Moreover, the adjusted EBITDA for this segment plummeted by 80%, indicating significant profitability issues. These results suggest that the company needs to focus on improving its performance in the international segment to achieve overall growth and stability. Management's outlook and strategy. The company's management has expressed uncertainty about its future performance, stating that actual results may differ from estimates. However, despite this uncertainty, the company is taking proactive steps to drive growth through its Focus to Win plan. This plan aims to strengthen the company's position in the market by investing in various areas. One of the key strategies being implemented is cost reduction, with a target of at least $250 million in savings by fiscal year-end 2028. To achieve this goal, the company will continue restructuring actions, including the permanent closure of production facilities and recognition of charges worth $20-50 million in fiscal 2027. In addition to cost reduction, management is also focusing on operational execution and investing in expanding capacity and modernizing production facilities. The company has sufficient liquidity to meet its business requirements for at least the next 12 months, providing a solid foundation for these investments. Overall, while there are challenges ahead, management's strategy appears to be centered around driving growth through cost reduction and strategic investments. The company has made significant investments in its shareholders through both dividend payments and share buybacks. In terms of dividend payments, a total of $154.7 million was paid out over 39 weeks ended February 22, 2026, with an additional $52.8 million paid on February 27, 2026. This demonstrates the company's commitment to returning value to its shareholders through regular dividend distributions. In addition to dividend payments, the company has also engaged in share buybacks. Between February 22 and 27, 2026, a total of 2,858,311 shares were repurchased for $93.7 million. Furthermore, an additional 2,972,221 shares were repurchased for $193.8 million, as reported on page 38. These share buybacks aim to increase shareholder value by reducing the number of outstanding shares and thereby increasing earnings per share. Concerns about inventory buildup and supply chain disruption are valid based on recent data. The company has experienced significant inventory write-offs, with a notable example being the excess raw potatoes written off for $32.5 million. This suggests that there may be issues with managing inventory levels. Furthermore, an analysis of the company's inventory levels from May 25, 2025 to February 22, 2026 reveals some concerning trends. While raw materials and packaging increased by $51.1 million, finished goods decreased by -$4.3 million during this period. Additionally, inventories as a whole increased by $58.2 million over the same time frame. These numbers indicate that the company may be struggling to manage its inventory effectively, potentially leading to supply chain disruptions in the future. The significant increase in raw materials and packaging costs, combined with the decrease in finished goods, suggests that there may be inefficiencies in the production process or issues with demand forecasting. That concludes the financial summary for LAMB WESTON Holdings Inc. Feel free to comment below, and I will be happy to answer them when possible.